Hello and welcome to the new IFRS 17 insurance contract webcast on level of aggregation, part 1. Sometimes the level of aggregation is also referred to as the units of account. This webcast is part of the series that the International Accounting Standards Board is producing to support the implementation of the new insurance contract standard. My name is Laura Kennedy and I'm an Assistant Technical Manager on the Insurance Contracts Project.
My name is Joanna Yeo, and I'm a Senior Technical Manager on the Insurance Contracts Project.
Before we start, as usual, the views expressed in this presentation are our own, and not necessarily those of the International Accounting Standards Board or of the IFRS Foundation. A copy of the slides used in this presentation is available for download via the website. Those slides are accompanied by additional materials that we hope you will find useful. We have previously published several webcasts on IFRS 17 to support its implementation. These are available on our website. This slide shows how this webcast fits in with those other IFRS 17 webcasts. This webcast has been split into two parts. In this session, Part 1, we will cover why and how insurance contracts are grouped under IFRS 17. In Part 2, we will cover the recognition and derecognition of groups, and we'll also look at disclosure requirements.
Firstly, let us begin by understanding why, under IFRS 17, insurance contracts are grouped. Typically applying IFRS standards, recognition and measurement occurs at an individual contract level. For example, under IFRS 15, revenue from contracts with customers, and IFRS 9, financial instruments. However, the board decided that an individual contract approach would not provide useful information about insurance activities. Insurance activities often rely on issuing a number of similar contracts to reduce risk. This is sometimes referred to as risk pooling. Insurance contracts are grouped applying IFRS 17 for the purpose of determining the profitability of insurance contracts. However, if we measure profitability using a group with a large number of insurance contracts, we might lose some useful information about how different types of contracts are performing. This is because under IFRS 17, profit is treated differently from losses. A loss is recognized immediately in profit and loss when known, and in contrast, profit is recognized over the period in which the entity provides insurance coverage. The level at which we measure profitability will impact when information about losses arrives in profit or loss. So, we have said that grouping of contracts is required for measuring profitability. Is grouping required to determine the fulfillment cash flows? The answer is no. An entity should estimate the fulfillment cash flows at whatever level is most appropriate from a practical perspective. For example, this could be higher than at a portfolio level or on an individual contract level. This is because, unlike the differing treatments of profit and loss, there is no asymmetry in the treatment of positive or negative movements in the fulfillment cash flows. All changes in estimates are treated in the same way. What is important is whether these movements relate to current and past or future service. For future cash flows, the measurement is the same for both expected future cash inflows and outflows. Similarly, any movements in the risk adjustment for non-financial risks are treated the same way, where the movements represent an increase or a decrease. If an entity does measure the fulfillment cash flows at a different level to the group level, then it must be able to allocate these estimates to the relevant group of contracts to determine the profitability of each relevant group.
Over the next 3 slides, we will go through Example 1. Example 1 is a simplified example of why measuring profitability at an individual contract level may not best represent the principle we covered earlier, that insurance activities often rely on a number of similar contracts being issued to reduce risk. In this example, 3 insurance contracts are entered into. At inception, the contracts are identical. Each contract has an equal probability of 33.3% of making a claim. As a simplification, the risk adjustment and the discount rates are assumed to be nil. In the next period, it emerges that the probability of contract 3 claiming has increased, which results in the contract being loss-making when looked at individually. Also, the probability of contracts 1 and 2 making a claim has decreased. Overall, when looked at as a group, the likelihood of claims is developing as expected. In other words, from a group perspective, there is no gain or loss. This next slide illustrates what will occur if the 3 contracts are measured individually after initial recognition. For contract 3, the expected future cash outflows increases because of the increase in the probability of the expected claim. When measured individually, this change in estimates results in decreasing contract 3's contractual service margin to 0 and recognizing a loss for the remainder of the change in profit or loss. Contract 3 is onerous or loss-making. For contracts 1 and 2, the expected future cash outflows combined will decrease by an equal amount to the increase in the expected future cash outflows for contract 3. This will result in a higher expected profit on those contracts. The increased contractual service margin will be recognized in the profit or loss over the insurance coverage period. Let's now look at the same scenario if the profitability of the 3 contracts is measured instead as a group. At the beginning, the entity expected an equal probability of a claim for each contract, but did not know which contract would claim. When it later turns out that contract 3 is more likely to claim than contract 1 or contract 2, this is consistent with our expectations and is not a change in the fulfillment cash flows. The contractual service margin is recognized over the expected duration of the group's coverage period. Because there has been no change in the expected profitability of the group of 3 contracts between initial recognition and subsequent measurement, the board believes that grouping reflects the economic substance of this scenario better than treating the contracts individually, as was illustrated in the previous slide.
Example 1 was a basic example of why measuring profitability at an individual contract level may not best represent insurance activities. We'll now move on into example 2, which demonstrates why grouping at too high a level results in the loss of useful information. The entity issues contracts in 20X1 for the same specified insurance risk. In this example, it has facts and circumstances that indicate contracts with policyholders with characteristic A might be onerous. On the same day, the entity measures those contracts and they are onerous. The rest of insurance contracts have similar characteristics and does not have any facts or circumstances that indicate that those contracts might be onerous or any differences in profitability. The entity measures those contracts on initial recognition, and they are profitable. If policyholders with characteristic A were measured separately from the rest of the policyholders, a loss of CU50 from policyholders with characteristic A would be recognized immediately in profit or loss. The unearned profit from the rest of the policyholders of CU200 will be recognized over the coverage period for those contracts. In contrast, if policyholders with characteristic A were measured together with other policyholders and formed the same group, the unearned profit of the larger group would be CU150. that unearned profit will be recognized over the coverage period. The board thinks that offsetting the losses of the group of policyholders with characteristic A against the unearned profits of the rest of the policyholders would result in the loss of useful information. The board regards information about onerous contracts as useful information about an entity's decision on pricing contracts and about future cash flows, and wanted this information provided on a timely basis.
We have now completed the first section of this webcast, Why Insurance Contracts Are Grouped. We will now move on to the second section of this webcast on how insurance contracts are grouped, and will explain the process in doing so. Firstly, an entity must identify portfolios of insurance contracts. A portfolio is made up of contracts that are subject to similar risks and that are managed together. Contracts in the same product line are expected to have similar risks, and so would be expected to be in the same portfolio if they are managed together. Contracts in different product lines would not be expected to be in the same portfolio because they are likely to be subject to different risks. In this example, each line of business is its own portfolio. Portfolio 1, whole life insurance, Portfolio 2, annuities, and Portfolio 3, car insurance. The entity will need to exercise judgment to determine each portfolio. The entity will then need to assess whether the portfolio should be divided further into groups.
Portfolio of insurance contracts should then be divided into, at a minimum, a group of contracts that are onerous at initial recognition, if any, a group of contracts that at initial recognition have no significant possibility of becoming onerous, if any, and a group of any remaining contracts in the portfolio. Depending on the contracts, the entity may end up with only one group, or two, or three. IFRS 17 permits these groups to be further subdivided. For example, an entity may choose to divide the contracts into groups with differing levels of profitability. The grouping assessment discussed in the previous slide can be performed by measuring a set of contracts as opposed to on an individual contract basis if the requirements in IFRS 17 are met. An entity may assess a set of contracts if there is reasonable and supportable information to conclude that the contracts will be in the same group. If the entity does not have such information, the entity will determine groups to which the contracts belong to by considering individual contracts. After applying the requirements of IFRS 17, a group can be made up of any number of sets of contracts or an individual contract.
On this slide, we will illustrate the assessment performed to determine the group to which a contract or a set of contracts belongs to. Firstly, the entity measures a contract or a set of contracts as permitted by IFRS 17. If the outcome of measurement is that there is an expected net inflow, and therefore a contractual service margin, the entity will then need to assess which of the two groups the contract belongs to. Either the group where at initial recognition there is no significant possibility of becoming onerous, or if not, the group of remaining contracts in the portfolio. We discuss how an entity makes this assessment in the next slide. If the outcome of measurement is that there is an expected net outflow, this represents an onerous loss. Those contracts belong in the group of contracts that are onerous at initial recognition. In addition, an entity may be required to recognize a group of onerous contracts earlier than typical recognition requirements if the facts and circumstances indicate that some contracts might form an onerous group. If you are interested in this, please listen to our previous webcast, Recognition and Derecognition. There is also a simplification for when the entity applies the optional premium allocation approach, which we will come on to later on. As discussed in the last slide, If a set of contracts is not onerous at initial recognition, an entity must decide whether they belong in the group of contracts that at initial recognition have no significant possibility of becoming onerous. If not, the contracts will be included in the group of remaining contracts in the portfolio. This assessment should be based on the likelihood of changes in assumptions that would result in the contract becoming onerous if they were to occur. The entity should use information from internal reporting. An entity is not required to gather any additional information about the effects of changes in assumptions on contracts beyond what is already gathered for internal reporting. There is a simplification for this requirement when the entity applies the optional premium allocation approach, which we will come on to later on.
We have been discussing how an entity would need to assess and divide contracts belonging to a portfolio into 1 to 3 groups as illustrated in this slide. There is an exception to this requirement when contracts within a portfolio would fall into groups only because of restrictions in law and regulation. We explain this further in the next slide. There may be regulations or laws that constrains the entity's ability to charge different prices based on a particular policyholder characteristic, for example, gender. If contracts within a portfolio falls into different groups because law or regulation specifically constrains the entity's practical ability to set a different price or level of benefits, and for no other reason, then an entity may include those contracts in the same group. This exception does not apply to the other level of aggregation requirements. The next few slides provide examples of how the IFRS 17 requirements are applied to divide a portfolio of contracts into 1 to 3 groups.
Let's first look at example 3A. Example 3A is an example of the treatment of contracts that are not restricted by law or regulation. In this example, the insurer has issued 2 sets of insurance policies, Set A and Set B. Set A and Set B sit in the same portfolio. The premium has been set to reflect the risk characteristics of each set. Set B is considered to be higher risk, and so a higher premium is charged to compensate for this when compared to Set A. The entity has reasonable and supportable information that the contracts in Set B will all be in the same group. In addition, the entity also has reasonable and supportable information that the contracts in Set A will all be in the same group. Both Sets A and Set B, when measured separately, are profitable. The entity assesses that both sets have similar possibility of becoming onerous, based on the information gathered for internal reporting purposes. Accordingly, the entity can choose to include both Set A and Set B in the same group. On this next slide, in example 3B, we take the same situation as the previous slide, example 3A, except that in this example, the insurer has made the decision not to charge a higher premium for contracts in Set B, and as a result, Set B, measured separately, is onerous. Set B has a higher probability of claims occurring than Set A, and so when measured, Set A is profitable with a contractual service margin, whereas Set B is expected to result in an onerous loss. Applying IFRS 17, these sets must be in separate groups. Set B will be in the group that is onerous at initial recognition. The entity will need to assess whether the contracts in Set A have a significant possibility of becoming onerous to decide which group it belongs to. We'll now look at example 4. This scenario is the same as the one we have seen in example 3B on the previous slide, except that in 3B, the insurer had made the choice to set a premium that does not reflect the probability of the insured events of Set B. In this example, example 4, the insurer is actually restricted by regulation and so must charge Set B the same premium levels as Set A. The entity goes through the same process described in the previous slide. If Set A was measured separately, Set A would be profitable. If Set B was measured separately, there would be an onerous loss. Because regulation is the only reason that Set A would be in a different group than Set B, the entity can choose to include both sets in the same group. The entity would then need to decide which group both Set A and Set B together belong to. There is a simplification for the assessments involved in grouping requirements discussed in the earlier slides, available for insurance contracts applying the premium allocation approach. When assessing which group a set of contracts belongs to, an entity applying the premium allocation approach can assume that no contracts are onerous at initial recognition, unless the facts and circumstances indicate otherwise. In addition, under the premium allocation approach, the entity will need to make the assessment between the other two minimum requirement groups based on the likelihood of changes in the applicable facts and circumstances. We have a separate webcast called Simplified Accounting for Short-Term Coverage Periods, which discusses the premium allocation approach.
The third and final requirement of grouping insurance contracts is the prohibition to include contracts issued more than a year apart within a group. An entity shall divide groups as necessary so not to include contracts issued more than 1 year apart in the same group. Each group shall include contracts issued up to 1 year apart. This can be any length of time up to 1 year. This period does not need to be restricted or aligned to the entity's reporting periods. This requirement is sometimes called the annual cohort requirement, but as discussed, the contracts included can be less than an annual period. For example, if an entity manages a particular group of contracts in quarterly cohorts, it could decide to recognize groups of contracts issued within each reporting quarter. The next few slides highlight the useful information provided by this requirement.
This simplified example looks at different generations of the same product, issued on 1st of January 20X1 and 1st of January 20X2. Both generations of insurance contracts belong in the same portfolio and qualify to be in the group of contracts with no significant possibility of becoming onerous at initial recognition. Each generation has an expected coverage period of 2 years, and the level of cover provided per year is the same for each year of the coverage period. On the day the contracts are recognized, contracts issued on the 1st of January 20X1 have an unearned profit of CU 600. Contracts issued on the 1st of January 20X2 have an unearned profit of CU 150. The only difference is that contracts issued in the later periods are less profitable. This next slide shows the amounts of profit recognized in the relevant periods. Firstly, you can see the amounts of profit recognized applying the IFRS 17 requirements. That is that the contracts issued in 20X1 will be in a separate group than the contracts issued in 20X2. Secondly, you can see the amount of profit recognized if contracts issued in 20X1 and 20X2 are included in the same group. In 20X2, the unearned profit of contracts issued in that period will be added to the existing group. We have provided further breakdowns of how these numbers have been calculated in the appendix of the slides available on our website. We can see on this slide that there are differences in the amount of profit recognized in the years 20X2 and 20X3. In 20X3, contracts issued in 20X1 are no longer in force or have been derecognized. I want to highlight that the reason CU150 is recognized in 20X3 when there is only one group is because the unearned profit of the contracts issued in 20X1 is included in this period. This is because the entity does not track the unearned profit at a lower level than that of the group. Accordingly, this is why the board believes that the requirement that a group should be made up of contracts issued no more than a year apart provides useful information. Doing so allows the recognition of profit in the period that the services are provided. That's the end of this webcast, Level of Aggregation, Part 1. We hope that you found it useful. In Part 2, we will cover recognition, derecognition, and disclosures. As stated before, we intend to produce future webcasts and other materials to support the implementation of IFRS 17. Thank you for listening to today's webcast.
Thank you and goodbye.